In order to invest in real estate, there are some key concepts and terms that you have to understand. It's nothing more than jargon, and it's nothing that you can't, as a professional or a dentist, won't have any trouble understanding. It's just a matter of taking the time to learn it. On this video, we're going to break down what is the capital stack, what are the components of it, and why it's important. Welcome back to the channel. I'm Johnny Walker. I'm a successful endodontist with multiple dental practices, as well as a self-made millionaire in real estate investing. Investing heavily in real estate over the last dozen plus years has allowed me to take a giant step back from my clinical practice, spend enormous amounts of time with my family and loved ones, take 6 to 8 vacations per year, as well as pursue my passions, which is investing in real estate, as well as teaching my fellow dentists principles of financial literacy and wealth building. Before we get into today's video, please, if you haven't already, subscribe to the channel. It helps the channel grow, as well as it gives us encouragement, as a lot of these videos take hours of research, as well as time to build thumbnails, have descriptions, and post these videos in a highly curated fashion. Also, please click the like button very gently on your phone or computer, as this helps to hone the algorithms of YouTube to make sure this content reaches people that could benefit from it most. Let's get started. What is the capital stack? Let's take a real life example. We just closed on a 300 unit property in Houston, Texas. This property had a total cost, including renovations, of $40 million. Now, the capital stack means we need $40 million total in order to purchase the property. And that is referred to as the capital stack. The capital stack is comprised of two components: debt and equity. The debt on this particular transaction, we borrowed $26 million from the bank in the form of a first mortgage. That is referred to as debt. The other $14 million to make up 40 came from its investor dollars, as well as the sponsor. All the money that's required, that's other than anything that's not borrowed but pooled together, that $14 million is called equity in the capital stack. So very simply, debt plus equity equals the capital stack. This is a very nuanced term. It's a term that's thrown around very frequently, and so it's a good idea to understand what it is. Now, another thing to know about the capital stack is where the debt and the equity lie in the capital stack. So if the capital stack is like this, the bottom or the least riskiest position is the debt. The debt portion of the capital stack is who gets the money first. That's first in line. If it defaults, that lender will get that property, and that's called being lower in the capital stack. The higher you go up in the capital stack means that your position is in a riskier position. So an investor that's at the top of the capital stack should expect a higher rate of return because they have the highest risk in the deal. They're the last ones to get paid when a property is sold. So if something happens wrong and something doesn't go right in the business plan or in the exit strategy of a real estate investment, the people at the top may not get paid. And so when somebody says we have a favorable position in the capital stack, we have a low position in the capital stack, means that they're in a relatively safer position than somebody that's higher in the capital stack. Very simple terms. Very important to understand. All right, guys, that's it for today. Hope that helps. Short but sweet video, and hopefully very informative. See you guys next time.